the IRRs right now, they're not complementary to what you feel you've got. Is that because, again, coming back to, we need to be, as investors, we need to be thinking this is a long-term play?
Well, basically, when you look at large projects of this sort of scale, to get a project like this up to, say, a 20% IRR, which we show in the deck at I believe it was $1,400 gold price roughly. There's very few large-scale projects like this that end up with those kind of IRRs. So we feel pretty good, and obviously we're trying to de-risk it and improve the economics with the work that we're doing, with a target to move up towards that 20% IRR range with the discount rates as we showed them in the PEA.
Right. So I guess I'm trying to get the balance between getting in early with some potential upside as you build out the resource, because you're talking, it's a very large district-wide body you're working with here. This is not a small company or a small asset, because there are more attractive grades out there. They're more attractive, immediate, seemingly immediate returns with lower costs associated with them. I mean, how are you selling this to people? I mean, when you're talking to investors, what are you saying to them?
Well, I mean, it's still a growth story as we speak right now, like I mentioned earlier, with the exploration works on. And, like I say, Ecuador is evolving and it's becoming a premier mining destination. And the sovereign risk related with Ecuador is going down substantially. I mean, we've seen in the time that we've been in the country, the royalty rate, the windfall tax disappear, the royalty rate reduce, the fiscal tax regime reduce, so that you've attracted majors like I mentioned earlier, BHP, Anglo, First Quantum, Newcrest. So basically, it's one of the last systematically unexplored jurisdictions in Latin America and probably the world. So basically, the upside for investors are participating in the early stage of the project. The project has enough legs that will likely be built as a mine in the future. And we're doing all the work we can to identify the scale of it, which looks like it's growing at this point, de-risking it, putting in place the permitting. And, if you compare it to a lot of the, let me just scroll through the deck here for a second. This is kind of important to go to page 14. Basically what we did here is we looked at gold producing projects that have the potential of over 250,000 ounces a year. And on this slide, what you'll see is projects in blue and then projects in yellow. So basically, Cangrejos is the 5th largest global development project controlled by an independent developer. And all the blue ones are majors and mid-tiers. And if you look at how it stacks up, the project is significant. I mean, we have about 373,000 ounces of gold production a year.
What are the assumptions that's based on?
Well, that's based on the PEA study, and that's the economics that we did in the PEA study. So basically, if you go to, let me scroll around a little bit more here, the slide on number 11, let me just walk through the PEA metrics real quick and you get a feel for it. So on the bottom left on page 11, we're looking at initial production of 40,000 tons per annum. The initial capital cost there is $831 million US. And then in year 5, we would finish an expansion to 80,000 tons per day. That's another $406 million of initial capital. And then the life of mine is 16 years, so there's another $271 million of sustaining capital. And then if you go up to the production scenario, the first 5 years, you get 270,000 ounces of gold a year and 25 million pounds of copper. And then at the expansion, starting in year 6 through 16, it's 421,000 ounces a year for the overall average of 373. And the other aspect that the project has in its favor is, low operating costs. So if we look at C1 cost, we're looking at $523 an ounce. Yeah. And then if you look at AISC on gold, we're looking at $569 an ounce. And then because it has copper, if you look at gold, gold equivalent, our cash costs are 706 C1 cost and 741 AISC. So that gets us down to the pre-tax IRR of 15% and the NPV at $920 million, and that's at $1,300 gold. Now, one of the interesting aspects of this is we did this on the 5% royalty rate, and the government has just changed the scale on the royalties that you negotiate with an investment contract. So if we were to go to the 3%, the bottom rate, and the government did this acknowledging that some of the projects like Cangrejos don't have the high grades that, say, a Lundin Gold, Fruta del Norte does. So the government, if we could get 3%, that would bring the post-tax NPV up to $1 billion roughly. So, we've had initial conversations with the government, and we need to continue to move the project along to get an investment agreement in place. So, there's upside in that context.
Right, but I mean, just again, for investors new to you, new to this part of the world, explain to them what large-scale, low-grade mining involves.
Yeah, I mean, basically long mine life, and I think it's an economy of scale type project, right? So, for instance, Ecuador has low power costs. It's about 6 cents per kilowatt hour. It's a diesel producing country in its oil sector, so diesel is relatively inexpensive. The project itself has a low stripping ratio. So when you look at all of these aspects from an operating cost, when you look at whether this project will be feasible and during production, will it generate good free cash flow? Really, it comes down to two things. It's not so much the sustaining or the initial capital. It has more to do with the operating costs and the gold price, right? So we can't control the gold price environment, but we can, with the scale of this thing, be very effective in the operation of it. And so there's quite a few things going for it. That's why you see on page 11 that it's got favorable cash costs, right? And when you benchmark it against a lot of other gold projects in the world, and if we go over to slide number 15, for instance, when we start to look at average gold production versus all-in sustaining costs, Cangrejos, it ranks really well compared to its peers, and that even includes Fruta del Norte, that's quite a bit higher grade. We're producing similar amount of gold every year. And then if you look at the mine life versus the US dollar capital per ounce of mine, the capital efficiency, as you would say, it's sort of $250 an ounce. So that benchmarks well with peers as well. Yeah. So Cangrejos, compared to other independent developers, is a long life, low cost asset. And, if you go back and you look at page 14 again, you can see a lot of the high capital cost projects, or a lot of the blue projects to the left of Cangrejos. A lot of those projects are looking at quite a bit higher initial capital to operate.
Yes, again, help us understand this a bit better. So this is all being based off a PEA, which is a very, well, it clues in the name, preliminary document.
Sure.
But, in terms of the team's experience of moving projects from PEA stage, the assumptions you're making, tell us why you're confident of being able to, get through to, a point where someone will want to take this off your hands, because the economics are delivered as you are forecasting them here.
If you look at our history with the Lumina Copper story, and that's the best way to compare it. When we, the first major project that we advanced, and it's a mine today, is the Caserones mine in Chile, and it's a large copper porphyry mine. Listen, we took the same approach. We went in and explored it, tried to fully define it. We went ahead and de-risked the project, and it was acquired by Pan Pacific. So the key to that was really good, solid engineering exploration work so that the project was de-risked. And then we moved on. I was the CEO of Northern Peru Copper, and that project was acquired by Chinamin Metals and Jiangxi Copper. And what we did there is we did a PEA, real solid engineering work, and we were at the pre-feasibility stage, and it was acquired, for $550 million US roughly. Then we were involved in the Relinchio project, which is a tech project today in Chile. And that project, we had a resource estimate. We were still doing exploration drilling, very similar to where we're at with the Cangrejos project. And Teck acquired that project, and it's in the development pipeline today. And when Teck acquired it, they did a lot more exploration work in it, and it's a much larger project. Now, the ultimate one that we sold was Taka Taka, the First Quantum. And that project we did at the PEA level. We took major risk areas like the pre-strip, metallurgy, water, and we advanced that work to a pre-feasibility level. And First Quantum acquired the project, and that's next in their queue after Cobre de Panama. So that's going to move into the development scenario. So I think as far as an exit goes, basically the level of work that's being done now should give most companies comfort that this project can move forward and be economic in the future. And obviously a lot of that depends on the gold price, copper price environment. But there's very few projects out there with this sort of scale, particularly ones that are in independent developers' hands, So I think that the potential for a major mid-tier to come in probably before we even complete the pre-feasibility study exists. And then ultimately, if we have to continue to move towards pre-feasibility study, we're doing all the work right now to continue to advance the project.
Okay, so I'm hearing it's a large project. We've seen it before, we've done it before, and we've delivered for investors before.
Exactly. And I think just to highlight that, in the Lumina Copper scenario, we raised about 175 million and returned about 1.5 billion to shareholders. And I guess maybe the best way to look at that is if you flip over to slide number 17, you can see the tombstones for all the different companies that have been part of the Lumina Group. Yeah. And the senior management team and Ross have been involved in all these companies. And that's been our business plan, our model, and we've been very successful at it. And very few companies have done that. Right. I guess on another note, the Anfield Gold asset that's shown there, that was merged with Crux and with Newcastle to form Equinox Gold, where Ross is the chairman. So, we have a long history. We have access to capital. We have the ability to execute technically, and we have the wherewithal socially, environmentally to navigate difficult jurisdictions. And Ecuador is evolving in a really positive way. And we feel that we'll be successful in Ecuador as well with Lumina Gold.
Yeah, no, we heard the Equinox story earlier this month. Great story there. Do you think that the Ross Beaty factor always helps? Because you said it just now. You feel confident about being able to go and raise capital for the next stage. So on the money front, you've got 14 million bucks in the bank now. What are you gonna deliver in 2019 with your cash?
Basically, that cash gets us through the year, and the bulk of the money is going into the ground in Ecuador right now, related to the drilling programs, the engineering work, the metallurgical work. All of that is where the majority of that money is going. We run pretty thin corporate overhead. So most of the money is in the ground, and it's going towards de-risking and further understanding the extent of the project, particularly understanding the new BESTIA area, which could be a project changer from the PEA.
Right, okay. And are you raising any more capital this year, or are you good?
We don't anticipate it at this point. Now, basically, if you look at the history of the Lumina Group, we've just got 6 holes into BESTIA. Newmont drilled 5 holes. We just finished a hole that was some 800 meters deep, and we hit mineralization through it, and we're in the process of really getting into the Gran Bestia area. Now, if we continue to have good success there, we may bring more drill rigs in. And that's the history. Like if you look at the Taka Taka project, we started with 1 drill rig and ultimately ended up with 10 drill rigs. So that's the only thing, continued success there, that could change the spend for the year. And if that happened, we would evaluate where we sat cash-wise and determine if we need to go back to the market.
Marshall, our investors want to know how you're going to make the money. How can you answer that question?
Yeah, I think basically one of the main ways to look at that is we still haven't discovered the full scale of this project. And I think what I want to do is direct you over to slide number 10 in the deck. And I think this really shows you the upside here, which isn't realized in the market at this point. And basically, if you look at the right side of slide number 10, that is the Cangrejos deposit. And basically what you see on this slide is the pinkish color is all of the gold equivalent grades between 0.35 and 0.85. That's all above the cutoff grade that would go into the mine plan in the PEA. And then the hot red color there is over 0.8 grams per ton gold equivalent. And what you can see in this slide is that there's a significant deposit in the Cangrejos deposit at the right, where the majority of those drill holes are. And about 1 kilometer to the left of that is the Gran Bestia project. And basically what you see there is 5 of the Newmont holes and 2 of our holes. Subsequently, we drilled 4 more holes, and this thing's holding together. What we don't know is if this is a true satellite deposit, if the 2 deposits are connected and are 1 deposit. So if you look at that slide, there's this breccia outcrop at the surface, which is 4.8 grams per ton gold and 2.3 grams per ton silver. And basically, there's some other intercepts around 10 grams. And this is all at the surface on the very edge of the pit, which is that gray outline. And listen, if these 2 things are connected, and we're going to drill in between, we're going to fully understand the size of Gran Bestia, which looks large at this point. If these 2 things are connected, you've got a really large pit, which would totally change the scale and the economics of the project. So as we have it right now in the PEA, just the deposit at Cangrejos on the right is included in the PEA. Everything to the left at Gran Bestia is not. So that's going to be new resources added. And if the 2 are connected, it's a substantially larger deposit. So there's upside on the scale of the project, the number of gold ounces.
And potentially the grades they seem higher at the surface. Why is that?
You know, the outcrop at the surface, that could be a little bit of secondary enrichment from the oxide near the surface. But we do have good gold grades. For instance, the best Gran Bestia gold grade was, I believe it was hole number 99, was 208 meters of 0.91 grams per ton gold and 1.16 copper right from the surface. So, you know, like I said earlier, we're looking to see if Gran Bestia will be a higher grade near surface starter pit, or if it'll just add resources to the mine life of the project. So there's some real upside in the scale of gold ounces that could potentially be discovered here. So that's a big upside for investors.